tell the audience about how you got started in real estate.
Welcome to the Masters in Real Estate podcast with your host, Tanner Webster.
All right, David Jangro, welcome to the podcast.
Thanks for having me.
So I thought we'd start off, you've got a very diverse financial background. Take me back to the college days at Dartmouth. What'd you major in, and how did it affect your financial wherewithal?
Unofficially, having grown up most of my life in Florida, I majored initially in learning how to layer and not get hypothermia and die. But once I figured that out, I majored in biological anthropology and evolutionary sciences. So natural segue right into finance. Definitely a time-tested academic path into that field, said with the utmost of sarcasm.
Yes. And so evolutionary anthropology, and then straight to a bank, of course.
Yep.
How did you, one, how did you end up there? And two, what were you doing there?
So I had interned at Everbank, and this was, I interned in 2008 and then started there full-time 2009. It was a local bank out of Jacksonville, Florida, where I grew up. So, just kind of did the natural sending resumes out, trying to get an internship, and then transition that into a full-time job. So I knew I wanted to kind of be back in Florida after spending 4 years freezing my butt off in New Hampshire. It was an interesting transition, especially given the academic background. But one of the benefits of the good old liberal arts Ivy League education is just teaches you how to think critically and be resourceful. So there was a learning curve, but it was kind of off to the races once I figured it out. Spent a lot of time on Investopedia.com to start out.
You and me both.
Yeah.
And what was like the title there, and what were you doing day to day? I mean, this is like the peak of the financial crisis.
Yeah, I started off as a capital markets associate and then a portfolio management analyst. And so this was right kind of in the peak and the wake of the global financial crisis. And what our group did, I worked in the capital markets and portfolio management group for the bank, which was essentially our trading desk for securitized products and other assets. So taking kind of pools of mortgages, mortgage-backed securities, and running them through any number of Excel models, picking them apart, putting them back together, and then some we would hold on our balance sheet. Others were sold back out into the market, sometimes to the big Wall Street banks that had originated these securitized products in the first place. So recycling.
And you mentioned before the show that Everbank kind of got spared in the 2009 crisis. How did they survive, but a lot of other people didn't?
Yeah, so we just no subprime, no Alt-A loans, none of the ninja stuff, no income, no job, no assets, those type of loans. So we were well capitalized, had a clean balance sheet at a time when a lot of other banks, especially smaller, regional local banks, did not. And in Florida in particular, there were just a number of carcasses essentially that we could pick over, and buying pools of assets for pennies on the dollar, picking out the good pieces, cleaning them up, and then selling them back. onto the market.
Now, I mean, I was in ninth grade when this was happening, so I don't remember a lot of this time, but I mean, why would a bank, they have these huge assets, why would they sell them for 30 cents on the dollar back then? Like, why would they sell for such a huge discount?
In certain instances, it was, bankruptcy proceedings. So it was just kind of a forced liquidation, sometimes an auction of assets. Um, Other times, banks that were still kind of holding on by the skin of their teeth just needed, liquidity and needed to maintain some of the, new capital ratios that were imposed on banks at the time. And so they were just getting anything that they could, basically selling the tires off the car as they were continuing to try to drive it down the road.
Classic Jacksonville, Florida, in a nutshell, right there.
Yeah.
Okay. And you mentioned you were doing some Ginnie Mae stuff, kind of pooling those pools of mortgages that you were talking about. You were kind of unpooling them and restructuring those. Can you talk a little bit about that?
Yeah. So when we would acquire those pools of loans, and this is all a little ancient history, so you'll have to excuse me if I get some of the details wrong. But the way these Ginnie Mae loans work is there's a government guarantee after a certain period of default on these loans. So our job, once we would acquire these pools of mortgages, would be to obviously pick out all the bad ones that were, just no bueno at all, but then kind of model out based on borrower behavior and some kind of proprietary algorithms we had put together to see, okay, hey, if X percent of this pool of mortgages is 30 or 60 days delinquent, what do we forecast the total percent to be in enough of default to where the kind of government backstop will kick in, and then you bake that into the price and then sell it at market. So it's a little bit of forecasting based on borrower behavior, but it would allow us to kind of put a coupon on these pools of mortgages, and once we cleaned out the bad stuff, knowing that the majority would be subject to that kind of government backstop, we could take a cleaned up product back to the market.
Beautiful. So after you were done doing that, you got your MBA at Vanderbilt. What year was this, and what was the focus there?
This was, it was there 2013 to 2015. So anyone who's been to Nashville recently, it was really just around the time that the city was going through its kind of renaissance from just fun live music, honky tonk type town, to really getting on the map with a number of companies, either establishing headquarters there or bases of operations, and the city was just kind of growing gangbusters and hasn't stopped since then, which was cool to watch at the time. I got out before traffic got really bad, which fortunate timing on my part. But no, while I was at Vandy getting my MBA, I concentrated in investment management and finance because I knew that's the direction I wanted to go. And had some really cool opportunities to work with and to TA for some remarkable professors who had, real industry experience. I think I told you the story before. I had the chance to TA for the gentleman who created the VIX, the volatility gauge that's now often cited. Fascinating individual, super brilliant, but also had converted the entire bottom floor of his Nashville house into a Irish pub, complete with merch and everything. We'd go over there and have barbecues and, hang out, talk about financy stuff.
It's honestly a shame. Everybody thinks that finance bros are just bland and boring, but that guy's sounded cool. Okay, so investment management, was that mostly public stuff like stocks and bonds, or were you getting into alternatives? Like, what'd you learn in that regard?
It was mostly public stuff. So fixed income, equities. No, I did actually take a few courses in, real estate valuation. But the focus was mostly on anything publicly traded, because that's where the majority of industry jobs are. Now that being said, there's publicly traded stuff, and then there's kind of the alternative private investment side of those things, like hedge funds, private equity, etc. And I did take a number of courses that touched on that, because I had some latent interest in that area.
Okay. So graduate with the MBA, and then you head to Credit Suisse.
Yep.
RIP to Credit Suisse.
Yeah.
And what were you doing there?
So I was working as an advisor in their private wealth management and private banking division. Essentially that is working with high net worth, ultra high net worth individuals, families, some smaller institutional type investors, nonprofits, endowments, on the smaller side, to, primarily, or at least my focus was primarily on managing their money, creating portfolios of either single stock positions or, funded allocations to kind of flesh out their portfolio. And then there's a number of other banking services that are all kind of offered on, any big institutional bank's wealth management platform. They've got, trust and estate planning and your traditional banking services and all this other stuff. That is all of high value to a lot of these clients, but to me it was like, yeah, somebody else in the team will do that. I really just want to manage your money and kind of generate returns.
And how, with the wealth management stuff, how were you getting approvals and walking through kind of the single stock portfolio allocation, stuff like that? Could you just buy a bunch of Tesla shares and no one would bat an eye, or how did that work?
No. So it was definitely, by the time I entered that industry, it had been on a path of change for a while, but was all coming to a head when I really got into it, where back in the day, it was much more kind of Wild West. Advisors had a lot of autonomy and discretion in creating these portfolios. I'm sure there was some governance, compliance procedures to make sure you weren't just, loading up on, whatever the equivalent to Dogecoin would have been 20 years ago. But the direction it has gone since then is a real effort by these, banks or other large asset managers to centralize the investment strategy internally. So rather than having a bunch of advisors kind of running their own model portfolios or strategies or whatever, you've now got a small group of specialized individuals kind of setting the investment strategy and allocations internally, and then kind of feeding that to the advisors and saying, hey, based on your client's profile, this is kind of the box we want you to put them in. And you still have some discretion around what funds or managers you'd go into, but it really became more, in my sense, it became more cookie cutter. Now there are advantages to that. rather than having a bunch of advisors, some which are better than others at the actual money management component, um, creating client portfolios. Now you really have a specialized group internally doing that. But to me personally, the value in managing money for individuals with, 10, 20, 50, $100 million is saying, hey, I'm not going to put you in the same thing as, my other client. I'm going to, do something bespoke and white glove. And, we can kind of work together to create something cool and compelling that's, perfectly suited to what your goals are. So that was kind of the beginning of some chafage there for me in that industry.
And so, speaking of change, you went from there to Goldman Sachs, also in wealth management. Why make the move? What was different? Kind of compare and contrast those two.
So platforms were very, very similar. I think at that point, Credit Suisse and Goldman were really kind of the main competitors in the US markets in terms of just, kind of top tier, basically right below having your own family office, which doesn't become economical until you really have like 100 million, which is, an exceedingly small percentage of the population. But Credit Suisse and Goldman were kind of neck and neck as being that like top tier white glove service, very selective. There were only, I think 250 of people doing what I did across the country. And the change was precipitated by Credit Suisse decided to essentially sell off their U.S. private wealth business in kind of a roundabout way to Wells Fargo in late 2015. And I knew that was not the route I wanted to take. That would have been, kind of a one-way ticket to a more retail investor type of client base. And so Goldman was actually 2 or 3 floors up in the building our office was in at the time. I had known some of those guys from recruiting out of business school and just, making connections in the industry. And so once I saw the direction that Credit Suisse's U.S. private banking business was going, started some conversations there, and it was an easy transition. Basically just had to hit a different number on the elevator, every morning.
That's nice. And so you started off in wealth management, and then I guess we'll get into this a little bit later, but you mentioned to me one time that you were actually cold calling for these wealth management clients, and I think that's pretty applicable for a lot of the listeners here to kind of gain, equity capital by soliciting for high net worth individuals if you follow all the guidelines, of course. So when you were reaching out to these people, they were obviously wealthy. How'd you find out they were wealthy? How'd you get a hold of them? What were you doing?
Oh man, by any means necessary. So it is kind of the hardest part of I don't want to say that industry, but that particular role as an advisor is, rarely, if ever, do you just get handed a book of business. You kind of have to go out there and eat what you kill. So it's in the early stages a really strange mixture of, on the one hand, having to have all of this investment knowledge and expertise and capability, but then also being like a very sales oriented, business development type person, which often, those roles are at odds with each other, but as an advisor, you're kind of forced to mesh them together and do both at the same time. So I took a pretty analytical approach to sourcing business. There's a number of platforms out there that will give you, kind of guesstimates of net worth for individuals and contact information. And that's kind of the low hanging fruit, but everyone's doing that. So chances are if you find anybody on there, they've already been contacted by, 5 other people doing exactly what you do. So then moving kind of up the ladder a little bit, I did everything from, looking at uh, like using county assessor information to look at where, the most expensive homes were, and then tracking down, um, what entity those taxes were related to, piercing the corporate veil, trying to figure out who was behind them, and then finding contact information for those individuals. I'd also look at lists of attendees for any, large benefit functions or anything like that, trying to figure out, hey, if somebody's donating $1 million or $500,000 to somewhere, chances are they've got, some change in the couch cushions that, may amount to what our minimums were. And then did my fair share of just schmoozing as well, going to events where had a good, inkling that high net worth, ultra high net worth individuals would be. And then it's trying to figure out, how to contact them or who their gatekeepers are. And then the other avenue, which is a little bit of a crapshoot, because this is what everyone's going after in that business, which is major liquidity events. So when private businesses would sell, or individuals would cash out, or even, when athletes would get, new offers, sign new deals, any major liquidity event where there's money, liquid capital being generated and available, that's kind of the best case scenario for an advisor, because it's like, A, a lot of money to put to work, but B, it's in a format where it's not locked up or already allocated. So it's a nice big blank canvas from which to work and kind of deliver your value proposition.
And how receptive were these people when you're like, hey, I found you in a foundation, saw you donated a building in a college. You
Some
money? Like how those conversations?
Some more than others. It was definitely an exercise in like handling rejection and never taking anything personally. But you don't know if you don't try. And for a lot of those individuals, there was a need. And it's, the saying kind of, luck is the residue of hard work. And there were often times when I'd dial somebody up or send them an email that in my mind, I was like, this is a waste of time. There's no way this guy is going to respond. And just kind of by chance, they would be like, yeah, I actually, I'm looking for a new advisor. I'm not happy with my old guy. I've kind of outgrown him, or certain life events changing where it was just kind of natural for them to explore new options. But yeah, I mean, really the biggest takeaway there is just, you can't, hit a single or a double or a home run if you don't swing. And so it's just a process of, striking out a lot, but every once in a while, making contact and trying to knock the cover off the ball.
So if you were a ambitious real estate entrepreneur and wanted to do kind of a similar process, but for your private deals, how would you take that similar approach of looking these people up? Are you just calling them and saying, hey, my name's Tanner, you want to invest in my real estate projects? Like, you got to follow guidelines.
Right.
What would
And I following guidelines is important, because obviously, the quickest path to failure is running afoul of, the law or the SEC or FINRA. But no, I would say it's there's multiple avenues to finding and contacting these people, and that's really just, I think, leveraging what you're comfortable with and won't get burnt out doing. But more importantly, it's crafting your message once you do get in front of these people, because it's the classic elevator pitch scenario. You at best have 30 seconds to a minute to really, get these people on the hook and make them interested in what you're saying. So I think it's finding a way to deliver a message that is genuine to you. I'd say the easiest path to losing somebody's interest is if what you're saying or how you're saying it to them comes across as just canned or ingenuine or overly salesy. But really kind of reflecting on, hey, as a sponsor or a syndicator or whatever capacity you're raising capital in, what value am I really bringing to the table? And not what do I think is most valuable, but what is actually of value to these people I'm trying to connect with, and how do I tie that to my ability to deliver that?
And were there any common threads between those people? Were they saying, was everybody saying, I just don't want to lose my money, or I want to get the highest returns? I mean, I think everybody wants the highest returns with the lowest risk, but like, what were some realistic threads from those?
Yeah, so there was certainly that. For most of the high net worth, ultra high net worth individuals, their focus and really our focus too as an advisor was just, look, like, you've already done the hard work. You've made your money. You've generated your wealth. Now it's it's the saying, how do you what's the surest way to a small fortune? As start with a large fortune. And so our job was really to preserve their wealth, grow it, especially if there were legacy interests or multi-generational thinking there. So it was always, delivering that message. But I think the common thread, and this was an eye opener to me, that I learned early, because, I came in ready to dazzle people with, my knowledge of the markets and investments and, all this stuff. And I learned really quick that most people do not care about that, at all. Like, they're going to start yawning and, looking at their watch and find a reason to leave the meeting. What people really want, I think, once you check the box on, like, hey, this is, not, a fraud or an idiot, is they want to do business with people that they trust and that they like. At the end of the day, your job as an advisor is really to kind of take the brain damage of investing large amounts of money off of their plate onto your plate. So, as much as I would like to talk to these people about investment strategy and what's going on in the markets all the time, that's essentially what they're paying us to do, is for them to not have to pay attention to that. So whether it's good news, but more importantly, when it's bad news, they want somebody that they can actually stand to talk to. It's the airport test. If you're stuck in an airport, get a 3-hour layover. Can you stand, being with the person you're traveling with, or are you gonna, look for the next flight to anywhere, because you're tired of talking to them?
So much wisdom in these podcasts already. So we'll transition out of the wealth management, and then you decided to go to the hedge fund department. One, why did you do that? Two, what were you doing there?
So transitioned out of Goldman's wealth management group into their hedge fund strategies group that kind of sat within their broader alternatives team. And that it was the hedge fund space was kind of always of interest to me, because it's a black box, so there's some mystery around it. Hey, these super smart people are, either generating outsized returns or, able to deliver returns uncorrelated to the market. And, when they get bets right, they look like the masters of the universe. And so that was intriguing to me. There was also some interest there, just through family. My my dad was worked in the hedge fund industry for a number of years. His firm was actually one of the first. They were the first Tiger Cub. For anyone who's familiar with Julian Robertson, and
I imagine a lot of the listeners aren't familiar with Julian Robinson, just because I think the hedge fund world, like you said, is so misunderstood. So can you give us a little background on the Tiger Cubs, Julian Robertson, and what your dad was doing?
That, to avoid just giving a history lesson, essentially what the Tiger Cubs were Julian Robertson, very successful manager, would seed other managers, and kind of grow a portfolio of them, all independent and running their own strategies, because oftentimes these hedge funds are kind of born out of smart, capable individuals who may be working as traders, or may have a particular insight into a particular corner of the market, and they just need that kind of seed investment to get up and running, and then with that comes a track record and returns, and you can build the team, and it kind of takes it's if you've read any of Ray Dalio's stuff, he started Bridgewater and was running it out of his apartment for a while as an individual, and then obviously now they're enormous, but that doesn't happen without either you putting up your own personal capital, or in this case some seed capital to really get off to the races.
And I guess let's back up a little bit. I think people understand, what a real estate fund is to a certain extent, venture capital and private equity. I mean, what do hedge funds really do? Because they are all over the place. Like, I was listening to a podcast with Chris Pate from True North Advisors and Chris Powers. They were talking about buying distressed aircrafts after 9/11. And then later on, they were talking about buying real estate. Like, what encompasses the hedge fund?
Yeah. So I think the best way to define a hedge fund would just be, it's the basic structure of the fund. But with that, it then really opens up the box to what has now become kind of a broad palette of different strategies. So, hedge funds are referred to as an asset class in and of themselves, but within the hedge fund space, similar to any other asset class where there's a variety of strategies, there's really very differentiated flavors of hedge fund strategies. You have your traditional kind of equity long short, and then which is that's basically picking single stock positions that you're bullish on, the ones you'd go long, and then names that maybe you think are going to underperform, or are going to you would short,
Like GameStop.
Right. Yeah. And so that's kind of that's I'd say the traditional kind of most, not, I don't want to say vanilla because that sounds a little denigrating, but it's the most traditional, I guess, type of hedge fund. But then now you've got macro trading groups, CTAs, commodity trading advisors. You have merger arb hedge funds. You have event driven hedge funds. You have certain credit strategy hedge funds, and all different varieties of quantitatively driven strategies now, and each tend to have kind of their own profile in terms of risk or correlation to the broader market. But I would say maybe the best way to define hedge funds because I think, and you and I have talked about this before, when a lot of people hear hedge fund, they think, oh, it's just, some mysterious, secretive fund manager who's able to just generate outsized returns. I've watched Billions, and that I think informs their, and I can't stand that show. But in reality, the way I define hedge funds is they are a vehicle for achieving uncorrelated and diversified return streams when compared to broader public or fixed income indices. So the position that they play in a portfolio would be, hey, you've got your exposure to the broader market, whether that's the S&P 500 or NASDAQ or, some of the foreign developed indices or just the global market in general. And the way portfolio theory kind of works is if you can introduce another position or set of positions into a portfolio that have an uncorrelated stream of returns to that broader index of equities or fixed income, it can kind of shift the efficient frontier so that you can achieve more return with less risk. It's the ultimate portfolio diversification tool. The theory being, hey, with certain of these strategies, they can very often be up when the market is tanking. And if you look at historical returns, that's more often than not the case. Now that can work against them because there are times when, all these smart people with their smart strategies, kind of bet the farm on markets going a certain way. And then when it doesn't work out that way, an S&P 500 ETF can be up 18%, and hedge funds can be down, multiple percent.
So that brings me to another question. I think there's that popular story. I don't know if it's true or not, but Warren Buffett from Berkshire betting like $1 million or something that the S&P 500, just the broad collection of stocks, would outperform. I don't know if it was every hedge fund or just this specific hedge fund. And this gist of it that I got was, why would anybody invest in a hedge fund really if they don't continue to beat the market?
So I think it's important to consider the type of investors placing capital with hedge funds, because it's not your retail investors. There are they can't get access, but B, it doesn't really serve. There's other ways to accomplish the role that hedge funds would in their portfolio in a more cost-effective manner. But for the types of investors that make up the bulk of hedge funds clientele and investors, it's large institutions that have a need to match assets with liabilities. So if you consider the case of a defined benefit pension plan where they have X number of employees with X number of pension dollars, they kind of know how much they're going to need to pay out from that pool of capital, and they obviously just can't continue to pay principal, and then you'll end up with a situation like our social security system. But so for them it's like, well, the traditional 60-40 portfolio, 60% equities, 40% fixed income, that's great, but it's still highly volatile. So if that you have X amount that you're going to need to pay these pensioners every year, you really can't afford to have significant down years or multiple down years. So the role hedge funds play in those portfolios is to diversify, and kind of drive that, uncorrelated piece of the portfolio to smooth out the volatility and make sure, hey, okay, maybe in years when, both fixed income and broader public equity indexes are down, we have this other little piece that's kind of like a volatility buffer that may outperform so phenomenally that it offsets the losses in those other areas. So with that, it's a highly valuable asset class, and to these pensions and institutional investors who also happen to be the groups with billions of dollars to allocate. So that helps when your average check size is in the order of tens or hundreds of millions of dollars.
So I need to I need to rebrand as a hedge
Yeah,
fund.
it's got its pluses and its minuses.
So kind of on those black box investment strategies. When you were at Goldman, you were working with funds of funds. Like it wasn't just Goldman Sachs and their hedge fund team. It was a subset similar to Tiger Global and the Tiger Cubs of a lot of different managers, and you were managing the managers.
Right.
Who were
So
managing.
we were running, we were building custom funds of funds. So essentially building a portfolio of managers, and obviously then those managers are running their own strategies. Gone are the days of prop trading desks. So yeah, it's not allowed anymore.
And so when you were, how did they vet these managers? And I guess, how do you come to start a hedge fund? Were these guys working at Goldman and then they said, I want to start my own hedge fund? How did that process evolve? And then,
Yeah, no,
yeah,
absolutely. That is certainly one avenue. Individuals who may be, working on a sales and trading desk, who then, develop knowledge of the market, learn how to trade in a certain space or vertical, and kind of learn the ins and outs of that space, and may feel that, hey, I can trade a strategy on my own, and then they'll kind of break off. There's also the route of it's just kind of like calving of icebergs. You've got individual PMs, portfolio managers who may be working in a larger multi-strategy shop like a Citadel or a Millennium, and they'll feel like, hey, I'm getting pretty good at doing this on my own. I think I can kind of break off, and I have the investor relationships to be able to bring enough on board to handle the administrative costs, and then kind of get up and running with this.
and so these guys would come to you and they'd say, hey, Goldman Sachs, we want $1 billion of your dollars or so. And how are you saying we want to get to this guy?
So typically we'd kind of steer clear of like purely emerging managers unless we knew them or knew of them at other managers, and we're like, hey, this guy's a rock star, have total confidence in him executing this strategy. In fact, it's probably better that he goes off and does it on his own. There were certainly those instances, but really it was, and we had a whole kind of manager due diligence team that would, there's so many facets that you need to look at, because there's the strategy itself and making sure that it's not, something, like, hey, Fred over here is going to pick a stock name out of a hat every Friday, and that's what we're going to go long in. Honestly, like, yeah, I mean, there's been a number of experiments where, at least in the short term, you can actually outperform with random strategies like that.
The classic is the monkeys throwing it
exactly. The problem with that is, even if it wins in the short term, when things do go wrong and investors are like, hey, why were we down this month? And you're like, oh, well, the monkey missed the dartboard. That's a tough conversation to have versus, hey, like, our thesis is still rock solid. things just didn't develop exactly how we thought. We're still high conviction in this area, and we're just going to continue to, test and refine our strategy and go forward. That builds a lot more confidence than, hey, the monkey's a little off this week.
And kind of on that note of strategies, I mean, Citadel, Bridgewater, those are kind of the big boys in the arena. Why are they so famous? I mean, like those guys aren't making the decisions themselves, right? So, like Ray Dalio is not sitting on a trading desk saying, buy this one, sell this one. What rose to their...
Bridgewater's a little interesting because to my understanding now, I think it's largely their trading is driven by computers, and the actual humans in that organization, their sole job is to keep the other humans from touching the controls in the computer. But I mean, they've, in all seriousness, they've been phenomenally successful. So the question, what's allowed them to outperform?
Or I guess who's making the decisions really? Like who's setting up these programs?
Totally depends. In
guy.
In some instances, yes, it can be one guy. Somebody with maybe a particularly unique brain in being able to understand certain market structures or movement can kind of dictate the overall strategy. In other kind of multi-strategy groups, you can have a few different portfolio managers kind of running their own strategies based off anything from the equity research they're getting from various shops in the street to who names it in the street, but it kind of flows upwards into a pyramid where you have a number of individuals coming up with ideas, testing those ideas, sometimes trading on those ideas, and then kind of as you move up, a smaller and smaller number of individuals kind of saying, hey, we like this, or we don't have conviction in that. We want to, increase exposure to this area, decrease exposure to this, and kind of take that 40,000 foot view and say, hey, I may really like your strategy and it may work really well in certain environments, but based on the conversations I'm having or my knowledge of, either the global economy or individual markets, I see things moving this way, which means we're probably going to decrease exposure to your strategy because it's just, not the right environment for that to perform as we want it to.
Okay, so moving on from the hedge funds, you got back into the world of real estate. Where'd you go?
So started at Colliers on one of their investment sales teams, and that was it was really more a means to an end. Knew the ultimate goal was to be managing money in this space, but wanted to kind of cut my teeth a little bit as close to the actual assets as I could. So also knew I could wear the kind of sales business development hat, having done that in wealth management before. So I wasn't really scared away by that piece of it, picking up the phone or cold emailing people. But spent a little bit of time at Colliers, and then from there moved to the group that I'm at now, Axia Partners, as their kind of director of investment, portfolio manager, CIO.
And Axia is relatively new. When was that? You guys are on Fund 2 now.
We're on Fund 2. We've launched a few other kind of special purpose vehicles individually, but the idea I think for Axia was kind of hatched in late 2020, and the group was kind of formally put together and launched our first fund in early 2021. in early 2021.
And what was in that first fund? What did you personally learn about real estate just coming from, you were doing everything before and now you're only doing real estate? What were kind of the learning curves that
Yeah, so it was, I mean,
received from that?
my whole thesis behind why I was so attracted to real estate and commercial real estate in general is because on on the public equities or fixed income or on that side, fixed income, or it's the market is so efficient now, to where it's just information overload, and it's really an exercise in just how well can you separate the signal from the noise. In real estate, there is a high degree of informational asymmetry to where you can really capture value by rolling up your sleeves a little bit and you know digging either in different areas or further than your competitors or colleagues or whoever are willing to do. And so that was really attractive. And so that that's and
Yeah, real estate's kind of the last inefficient market, I would say, and
It
seems
does,
like it
but I
gets
think
more and
there's
more efficient
still
every day.
just inherently and structurally, I think it's, I think it's the nature of the actual assets, the properties themselves, to where, you can have 200-unit garden style apartment complexes, both of the same vintage, maybe even built by the same developer, across the street from each other, and they can be entirely different. They can behave entirely differently. They can have entirely different, financial profiles, risk profiles, you name it. So it's very, very hard to commoditize an understanding of any particular asset type at any level of granularity in commercial real estate. Granularity and in commercial real estate, which is a pain in the ass. It means, every single asset you kind of have to look at in. Um,
Yeah. Um, Fund one was a super diverse fund. You had self-storage, RV park, multifamily. I believe there was a hotel in there. What did you like any of those more than the other as far as like an asset class? I guess what are you most excited about in the future outside of Salt Lake City industrial?
yeah, I'm very excited about Salt Lake City Industrial. But no, I honestly, our best deals in Fund One were in some ways the most boring. I mean, one of our best performers is an 80 unit, 19 Bill, Tennessee. It was just a pure down the middle of the fairway value add play. It was coming in by an asset at an attractive dollar per door basis, knowing that there was a lot of meat on the bones in terms of renovating the units and earning off lost lease and kind of achieving kind of resetting the market rate bar in that smaller market. And that one's just worked out super, super well, even with, being an older property. There's been some, typical, I mean, that one's done really, really well. That might, the ones that haven't worked out well, or I guess are kind of yet to be proven. Our RV parks are interesting because they certainly have the potential to generate a ton of cash flow, but they are operationally intensive to the nth degree. You're essentially running a hospitality business at the margins of a more traditional commercial asset. And you're dealing with new tenants coming in on a nightly or weekly basis. That's got certain risks associated with it, and it's also just not as liquid or highly traded of a market as your multifamily or self storage or industrial. So
hey, even if you can get into a great deal, how long is it going to take for you to get out of it? And what type of buyer are you actually going to be dealing with when it comes time to sell?
So you mentioned some interesting stuff like, what buyer you're targeting on the backside. Yeah, if someone said, "Hey, I'm going to start my first real estate fund," what kind of advice would you give them specifically regarding just your first fund and what you learned on that?
That's a great question. That's a great question.
Should have prepped you on this one. My bad.
No. That wasn't a stall. That was actually a recognition of it being a great question. No, I would say to anyone looking to start their first fund or syndicate their first deal, it's like, don't bite off more than you can chew, because you've really got one chance, especially starting out. Um, Even if you return single digits or low double digits or whatever to your investors, that's still a win in terms of principal preservation and you executing. But if you go out there and in an attempt to knock the cover up the ball, totally whiff, good luck, recovering from that. And I think it's really a game of you're compounding good decisions while at the same time avoiding bad decisions. You don't have to reinvent the wheel. You don't have to do anything. You're not sending a man to the moon. You're buying an apartment complex. Like, I think it's important to be honest with yourself about what you're actually doing. And sure, there's all sorts of marketing that can go into, generating, hype and playing on the emotion of real tangible assets, which is important. But it's equally important to not overextend yourself and just to say, hey, look, this isn't a new area. People have been doing this for decades and decades and decades. Just do the best you can to do it right, and then should grow organically on itself. If you treat your investors right, communicate well, don't overpromise, underdeliver.
Yeah, I am a huge subscriber to Moses Kagan's real estate theory of buying like those old families that live in basically every town across the country, where you buy it basically forever, refinance every once in a while, make sure you don't get over leveraged. And I mean, who really cares about an IRR over a 40-year time horizon? Interesting. So, and you're doing some SPVs with Axia. Can you talk a little bit about that, what you're excited about on those ones and kind of what you learned?
Yeah. I mean, in particular, I'm excited about, so the SPV we currently have is kind of a co-investment side pocket opportunity into a deal that we are funding with a significant portion of equity capital from our current diversified multi-asset fund. So I like the SPV structure, especially in regards to like the co-investment, because it I guess the analog I would use there is, airline pricing models. There's essentially a price for every seat and for every flyer. And it's just about finding, how to optimize the price every flyer is willing to pay to fill up the plane and maximize revenue there. I think that in this sense, it allows us to, still cater to our investors that are interested in getting, passive exposure in a diversified manner to commercial real estate, in which case the fund makes all the sense in the world. But for other investors who may already have exposure to real estate and who may want, more targeted or deal specific exposure, it also allows them to participate in the deal and allows us to, fully capitalize the deal by getting something that fits with their kind of demand profile. So it's also a great way, um, let's say, for example, you've got a $40 million fund. Well, you're obviously going to be limited by the number of assets that that equity can be allocated to. But if you can open up either all of or some of those deals to co-investment opportunities, you can fit bigger deals into the portfolio, or you can fit more deals into the portfolio and kind of enhance that diversification. So it really kind of stretches the mileage of your ability to construct a portfolio than just the equity you're limited to, if you were to solely rely on the capital of the fund.
And when you say co-invest, I think this is actually a question I asked you probably a couple of years ago, now that I think about it. When you say co-invest, you're talking there is the original fund 2, which has X amount of dollars on it. And then aside from that, there's co-invest opportunities for additional vehicles like the SPV, like other opportunities.
Right.
Correct?
So you are essentially co-investing with the fund.
Okay.
Having to be in the fund. So you're investing alongside, the large chunk of capital coming from the fund. So you're not, I guess it should give the SPV investors comfort in knowing, like, hey, they're not just going out, syndicating this large, on our current project, which is a 230,000 square foot multi-tenant ground up, warehouse development in Harriman. It's not like, oh, wow, okay, I'm investing in something where these guys have to go out, essentially syndicate $20 billion in equity for this deal to get off the ground. It's like, okay, we've got the backstop of, at minimum $10 billion coming from this fund. So there, you still kind of, like, in essence, syndicating part of that equity capital allocation, but you've got a big chunk of that committed and funded and kind of backstopped by the fund.
Cool. All right. I guess last question, where are bonds going to be in a year from now?
Oh boy. I think yields are going to have to go higher, because I think that, I think this government is just addicted to running budget deficits. And you look at, our, boy, this could get me in trouble. This could get me down around.
Just give us a number. We'll call it good.
Yeah, no, I think, I think the 10-year will be north of 5%. I just think yields are going to have to go that higher for the government debt issuance to be attractive to investors. And now whether, you see those yields rise as a result of, bull or then the yield curve normalize as a result of bull or bear steepening, that's obviously got different implications for the direction the economy is headed. But I as much as I would like to think that the Fed is going to come in, cut rates, act like the savior to pull us out of whatever recession we dip into, I think we're in a tough spot where, unfortunately, I do think the Fed will cut eventually, but I think it's increasingly going to be pushed to the latter half of 2024, and it's going to be in a very measured fashion, and unless the wheels completely fall off the wagon.
Well, everybody, you heard it here first. Reminder, this is not investment advice, but
No, it's not.
So, David, it was a pleasure. Thanks, man.
Tanner, thanks as always, man.